What's going on, everybody? I just wanted to go over a recent subject that we did in the webinar last night, and I was giving some real-time examples in the room today in the Traders Lounge just to kind of go over and how to pretty much anticipate that something's going to fail, how you should always assume that it's going to fail, and therefore use that liquidity to exit rather than buying breakout. Now, look, sometimes buying breakouts will work. There's a certain markets for it. So the first kind of warning sign post low float squeeze style market that we were in. So let's just say BPTH started everything, right? And then everything started to go nuts after that. ATOS, AKTX, SLNO, and a bunch of other tickers just started going crazy. They'd trap shorts, and if they didn't trap shorts, they'd bring it down, then trap them, and then work everybody out into new highs, and then kind of walk from the name. So I want to talk about potential probabilities, right? And if you're trading on the side of probabilities that make sense, 80% of the time, I would say, maybe 2 out of 10 actually break out. 8 out of 10 are probably going to fail. Maybe even 90% of the time they'll fail. But I would think that maybe 2 out of 10 runners actually have a nice secondary style move, a secondary breakout. ATOS is the one that kind of put this whole thought on my radar just because I got stuck in it. And, I had a really, really good entry. I was long in the morning and had sold some around a particular core. And then I started to kind of add into that winner, and, it was working really, really well. It was gearing up. It had a nice little breakout, and I was up quite a bit right here. Now, would I have been buying here? No. I don't want to ever buy into, so if you figure this is an ABCD style breakout, right? The idea is to never buy the breakout, ever. Because especially if the stock has ran, then there's a good chance that they just stuff right into it. The idea is once it starts to have higher lows and it's over VWAP, that you might start to accumulate on dips, anticipating a breakout, and then once it confirms, at that point, I'm interested in adding into a winner. However, the most important part is letting it break through that level, coming back and actually confirming and showing you that it wants to hold a higher low. A lot of times you'll see that they might just break through it, blow out some stops, and then come right back under. Other times it might not even break through it, but everybody anticipating that breakout ends up being the exit for somebody that just pulls the bids and they walk from the particular name. So in this case, this is a great example of a couple fails at the highs here, and how you should assume that it's going to fail at the high of day. If you assume that it's going to fail at the high of days, then you can always rebuy higher. You can always add higher. You can always put on a new position higher, right? Many times I say, in this particular case, I'd rather buy higher than buy here, anticipating the breakout, because what would happen is I would end up screwing up my average, and then in the event that it stuffs, I've just taken a huge win, screwed up my average, and potentially turned it into a loss. So this is a great example of, this was the first kind of warning shot, like, hey, we're no longer in a low float squeeze market, and this is now a sell into the rips and be cautious style market. And so the most recent examples, one was AETI today, and we were talking about it in the room, and you should assume that the high day is going to fail, right? There is a case where sometimes it might rip right through it, and that's fine, because you know what? If it rips through it and it starts to base over that level, well, guess what? You're going a lot higher. However, 8 out of 10 times, there's a good chance that it's going to fail. And it did exactly that. And then occasionally, just like I said on ATOS, it does actually break that prior high. So it might break that prior high right here, but not the high of day. And it goes through, and you can see that they basically created an exit. You can see the candle here was about 450,000 shares. throughout all of this, they were just kind of churning volume. There was a lot of big offers, and then they'd come back. A lot of big offers come back. So they're creating the appearance that something's actually happening. They create a little bit of a trap, and then they squeeze everybody out into their offers, which ends up being the 450,000 share candle, which was the highest since back over here on the last stuff candle. And they exited. They moved on, pulled the bids, and it closed right back where this whole entire thing started. So that's the concept that I want people to start to kind of see. Rather than buying breakouts, rather than having FOMO, and occasionally you're going to have FOMO. And if you do have FOMO, that's a chase entry. You're going to be in a very, very partial position. So in this case, it's okay to anticipate these style breakouts, but it's most important to sell into the strength. If you don't sell into the strength, you're basically taking your edge away, and you're saying, hey, you know what? Let's just see what happens. And when you're trading these trash names, if you just quote unquote see what happens, 8 out of 10 times, you're probably not going to be happy. So the key is to stick with your edge and stay on the right side of the trade, and make sure that if you are anticipating that breakout, the most important thing to do is to also use the liquidity on breakouts to exit, because you don't know if that next breakout is the one that they use to exit the entire move. And if that's the case, then just like you saw on the ATOS, they pull the bids and it's gone. And a lot of times those bids might just be shorts kind of timid trying to cover, and as soon as that emotion goes away, the bids are gone and they pull, and then that's it. And a lot of times you don't get a second chance to get out. So that's one example. Another example today was TBLT. And this actually had a fantastic move. It was grinding, it was holding on and staying pretty steady. But once again, what I would suggest, that we always call these lines in the sand, right? You always look at where the prior support was or where the prior breakout was. And in this case, if you just draw a line, you can see that it's been having trouble at the 143 level. So 140s, 143, whatever. So in this case, just like on AETI, you can just draw a line across and see that there was some trouble in the 155 area, 150, 155 area, right? So you're assuming that it's going to fail. It may not, but remember, you can always add back in or rebuy higher. And if that's the case, you want to buy higher because it's probably going to go higher. But 8 out of 10 times, you're probably going to be happy that you sold. So in this situation, TBLT had a very, very nice breakout, but the same thing, you're seeing the same exact thing again here with the 143s, 140 area where it peaks out. You can see the volume associated with that. Once again, it goes up, fails, goes up. Now this time it breaks through. But guess what? Immediately, instead of coming back and holding trend, holding above that level, it's right back under the resistance. So resistance here, breaks right through, comes right back under. If I wanted to be long this stock, if I wanted to anticipate a potential continuation trade and I wanted to get long, I would need to see this 145 level now become a base, not a new top again, because as it stuffs and each time that it fails, it's getting heavier and heavier, right? Because early shorts are covering, emotional covers. Maybe this is the last stop out. Oh crap, new high day. All right, fine. I'll short it higher later on. And then at the same time, this is when longs start to realize, it's not breaking out. And at that very moment, everybody realizes like, oh, yep, it's time to get out. And bam, everything's gone. So now you don't have the bids from timid shorts that are covering, that are trying to get on dips and whatnot. And you also don't have the support system in there, whomever might be behind it, supporting it, pushing it up, because they've already exited. So at that point, everybody starts to realize that at the same time, and everybody goes to the bids, and what happens? They get pulled, or they fill, and that's it. And you can see in this case, there was quite a bit of volume that came down, but everybody starts to realize the same thing at the same moment. And that is also the same reason why we talk about newsletters, and I would probably, rather than 8 out of 10 times, I would say 9.5 times out of 10, newsletters will mark the top. And the reason for that is because if everybody's coming in on the same note, if everybody's coming in right away, right? If you got 1,000 people all doing the same thing, and you hit a wall, say you're anticipating a 3 breakout, and all of a sudden, it doesn't bust. There's a bunch of volume comes in, it doesn't bust. What happens? Everybody is looking for the exit. It may take a moment or two to, maybe this goes, maybe it doesn't, maybe it goes, maybe it doesn't. But as soon as everybody realizes that, hey, it didn't break out, guess what? Everybody's going to go to the left side. Everybody's going to go to the bid. They're going to try to get out on the right side. They're going to try to get out on the offers, right? And that's when you start to get a little bit heavy. We call that heavy action. They're going to be trying, all right, I'll just put it on the offer. I'll try to get out. And then everybody starts to realize that they're not filling on the offer. So what happens? They all go to the bid side. And that's the same thing with the newsletters. If you've got 1,000 people doing the same thing at the same time, the moves themselves can get even more exaggerated, more knee-jerk reactions. So that's why sometimes you see them go into circuit halts, because everybody's doing the same thing at the same time. But on the same note, on the backside, it can go down into a circuit halt as well. But for the most part, they have huge red candles because it's a knee-jerk reaction to the market. Market doesn't know how to react, and everybody's doing the same thing at the same time. Emotions come out, and that's just how it works. And then last but not least, WKHS. We were talking about this one today, and obviously you can kind of see VWAP pressure coming in the morning. And as noted in the room, this is not a low float stock. So although it moved like crazy, there was just some very big positioned shorts, more than likely yesterday, that got squeezed out. Too much, too soon. And this thing isn't going to go into circuit halts, in my opinion anyway, especially on a move like this. 50 million share float is not a million share float, right? Company with no money, needs money. They have a lot of warrants. They probably blew out their ATM yesterday, et cetera, et cetera, et cetera. So what do you want? You want it to come back in and assume that pre-market resistance, which you can see it starts to come in and slowly coming in. You're going to assume that pre-market resistance is going to act as a top. And on that note, you look for the line in the sand. And obviously you can see that the line in the sand underneath here is the 220 level. But on that same note, like we were talking about today, it's 245 on the top. So if you're looking to anticipate a short, you want to be leaning into these rips. If you are looking to trade the washouts, and I did that today, you want to be on the offers. You want to be selling into this ramp, and you want to use that liquidity to get out. And if you don't, then it very easily can just slam right back. You should assume that every time it's going to go up to this level, it's going to fail. And remember that you can always rebuy higher. You can always rebuy higher. So if you take, for example, we go back, and I did this on the video lesson yesterday, and there's no reason to be in this thing like early on. There was absolutely no reason to be in it all over here. Like, oh, I had a 110 entry, 120 entry, 130. That's great. You just got lucky. There was a breakout. There was no reason to be in over here, because if you think about it, once again, we use that prior top as a guide. So you had, I think it was 142. Yep. 142, I kind of ignore this because this was prints after the halt up. But 142, and then right over here, you assume it's going to fail. It does, pulls back. It's consolidating around VWAP. You pretty much have 50-50 shot. Pick a trend, whatever you want. Pick a way. But later on, it starts to go, and then what happens? It busts through 142. So now you want to see it come back, confirm, come back, confirm, and each time it's pulled back, it gets accumulated. It gets bought up. So that's the point where I went long yesterday, and that's why I went long. And the difference here is that it is over that high, right? So you could be anticipating this big breakout right here. Nice curl. Looks like it's going to blow out, go crazy. But you know what? You're in the same situation as ATIS, AETI at 155, or TBLT at whatever it was, 145. You're anticipating something that has not confirmed. You're anticipating what might happen. But instead, look at all the volume that you're met with. You're met with somebody's exit. Thank you, come again, is what they're saying. Later on, though, obviously, we're over that resistance. Shorts are in a bind. All the dips are getting bought. You can see the wicks. All wicks are getting scooped up, scooped up, scooped up, scooped up, scooped up, and obviously away it went. So those are the key things to look for, and that's exactly the way in which we traded this thing today. All of these, and WKHS for me was okay. I wish I did a lot better with it, but I did. Again, you have to be reactive to the action that happens off the open, and it worked out pretty well. And again, just like kind of practice what you preach. The exits are the most important part over here. Now, obviously my entries are not perfect, and that's okay. Sometimes I scale in. Sometimes I put on little starters here and there just to kind of get a feel for it. But what's most important in this market is your exits. Most important thing is your exits after you're in a position. It's as long as you have a plan with your entry and a stop and whatnot, if you're anticipating particular moves, you need to use the liquidity for exits, because if you don't, you're going to get smoked. And same thing with this AETI. Now, I did have one chase. I had one bit dumb FOMO chase right over here. But for the most part, not bad. I went ahead and locked into all this action right here. And again, I went ahead and locked in and left it alone. Because if you're not on the offensive, if you're not being there, then you might not have an exit. You might end up getting trapped. So the only size that I used was on this first move. No size here, and even no size here in the middle of the day. It's not worth it to me, especially like this later move. The only time that I like size or size into a move is something like ABIO, for example, if you look when it actually trapped. And again, this is one more great example where we had a huge squeeze, but right over here, comes back up, rebounds, and it looks like it's about to go, slam. Rebound, slam. So this is a situation, just like every other time, where newsletter had come in, they bought it, sold, slam. And it just so happened to catch. So it's not about, buying it here and here and I was in it at $7 and I nailed it. No. The key is the fact that it broke through the high days. The key is the fact that it actually held trend and busted through VWAP, ripped up, came back, confirmed that it wanted to hold, and then squeezed out. So these are the keys that I look for when I'm trading these things, and is what you need to look out for, because if you are trading these and you're getting bent up, it's because you're not exiting properly. Some people will say you should never long these things at all. There's obviously great trades here. There's lots of opportunity, but the only other thing too is to kind of look left to kind of predict the right. So AETI, right away, the first thing you can do is look at the chart. Look at the last run that it had. Look at all the volume. Where did it peak out? Right here, 150. This day, 150. Next day, 150. Sure, it went a little higher because that's probably a morning move, and it ended up just kind of closing right under 150. So you know that there's resistance at 150. So how can you use that today? If it rips to 150, remember that you're probably going to have competition because that's where the sellers were last time. So you can always assume, look left to kind of predict the right. And that's something very important, and I think that it will help you on a daily basis if you always look at the daily chart real quick and just look for prior resistance spots. So if you guys have any questions, feel free to reach out. Hope you guys have a good night, and we'll see you in the room tomorrow.